everything's going down 90%. Everybody else is like, well, obviously, what a recession means is that all the banks go bust, everything goes bust. That's not normal. My first recession was 1990. Stock market went down 28%, GDP growth contracted by 2%, house prices fell, and people got tipped out of jobs. Standard recession. Lasted a period of time, the world moved on. That's what I think we've actually got here, is a very ordinary recession driven by Federal Reserve raising rates and prices going up too fast, which means that people can't buy as much stuff because your wages aren't going as much, and so everything slows down. Where's the big imbalance, right? We don't have this, the banking system got sorted out a lot. They're just not allowed to lend as much money. So we don't have those imbalances. So it's very hard to see what's really going to blow up. Now, everybody's earnings need to come down further. And therefore, we've got another leg lower. This is 2000 all over again.
Hey guys, welcome back to Library of Wealth. Today we have the Real Vision CEO Raoul giving us the latest market update and where we're headed in 2023. Last year we saw a massive withdrawal of liquidity, and with all the money coming out, the central banks were tightening rates and all banks stopped lending money. One of the first assets to go down was cryptocurrency because of its high risk, which made a massive impact on investors in Q4. Raoul says a recession is inevitable at this point, with inflation at a 40-year high and now higher interest rates. This may help curb soaring prices, but it also increases the cost of borrowing, which can make everyday financial products more expensive, like mortgages, personal loans, and credit cards. Right now, there are no signs rates will be dropping anytime soon, and the Fed says it will continue rate hikes in 2023. Let's get right into the interview with Raoul as he gives us his market outlook for the first quarter of 2023 and what his investment strategy and prediction is for crypto. Don't forget to like and subscribe if you enjoy the content we do here on this channel. Let's get right into the video.
The world is driven, this whole space is driven by liquidity and network adoption. So the adoption of blockchain technology is ongoing and relentless, but the liquidity of how much money's around drives the space. So once you understand that, you understand a lot about the space. So last year was a massive withdrawal of liquidity. All the money came out, the central banks were tightening rates, all the banks stopped lending money, all of that stuff, and it meant that all assets went down, and crypto goes down the most because it's the kind of longest duration, highest risk asset. So where are we now? So here we are right near the end of the rate hikes. The economy is probably going into recession and pretty soon. And so what happens is the market starts to look forward and say, maybe they'll stop tightening liquidity and take the foot off our necks, and maybe things, because our job in financial markets, particularly in macro, is to live in the future. Looking around today is useless, but looking around, what is the world going to look like in 6 months' time? Are the Fed raising rates in 6 months' time? Almost a 0% chance, because inflation has peaked, growth is falling, we're going into recession. Normally, they would cut rates at that point. Now, they might be a little bit slow to do that because they really, really want to see inflation lower. But it means that the rate of change of all these rate hikes and all this bad news starts slowing down.
We've already seen it start to slow. Their most recent rate hike was kind of below what their norm had been.
That's right. And so we're going to get to the point they're going to say, okay, enough. Meanwhile, China's been leading this. The Chinese economy seems to be a year ahead of everybody else's right now. And they started some stimulus process before their lockdowns, and now they've really started to stimulate because, they'd shut down their economy. So we're already seeing this global money supply, and people can see me post this on Twitter from time to time, global money supply year on year and Bitcoin price year on year. They mirror each other. So when liquidity starts to come back in the system, prices start to rise again. So we're at that point, which is why I've been really interested. So in crypto, we've seen that. I thought June was the low, and it was in ETH, some stuff, other stuff, no. But the point being is we've thrown the worst possible news. Prices kind of stopped going down. And now we're starting to see liquidity when everybody else is saying, can't you see, you idiots, you're going into recession. How could you own JPEGs when you go into recession? The point being is our job is to look a little bit further into the future. There's certain things going on. One is that things like retail sales are driven by the total amount of volume of goods. Now, because prices have gone up a lot, the volume can have gone down and it still looks like, hey, presto, everything's okay. But it's not. Everyone's selling less stuff. So there's these weird things around inflation that we've not had to deal with. And unemployment's a bit sticky, but GDP growth is still, by last measure, still positive. We had a couple of scares, a scare earlier last summer, but for me and my forward-looking indicators, it looks like it's all about to collapse.
At the end of 2022, the burning question on everyone's mind was whether or not the Federal Reserve's actions would cause the economy to plummet. In an effort to curb inflation, the Fed decided to raise interest rates a whopping 7 times last year. Despite their efforts, many experts and politicians were worried that such drastic measures could lead to widespread unemployment and ultimately trigger a recession.
Most people want to go back to the 1970s because that was the ghost
High
of the
inflation.
baby boomers past, right? So that's why Jay Powell, classic baby boomer, his ghost is, I'm not going to be Arthur Burns. I'm never going to let inflation come back. Right? That kind of weird inflation went down, then went up, then went down, then went up, was, I think, a demographic phenomena by these baby boomers, right? They all came into the workforce at the same time. They're all about 30 years old when that happened, and they all started, they were in their 20s and 30s, and they all started consuming stuff, and it was the largest population bulge in all history. I think the actual best comparison is post-World War II. Now, we're going back a long way here, but why World War II? So factories couldn't produce goods any longer, so we have this supply issue, and everyone came back out and went, I want to buy stuff. I've been locked in my house for so long. World War II was that, but bigger. And so what happened is all the factories were making munitions, and now they had to suddenly spin up and make washing machines, and it took them ages to get everything sorted out, and supply chains were broken, and the ships were all blown up, and all of that stuff. But people came in and they wanted to buy stuff. They had some optimism again, and prices rose 20%. So CPI inflation got to 20%. What happened 2 years later is it went negative, because this wasn't demand-led.
Right.
It was just this weird supply-demand imbalance that happened for a short period of time. Inflation did come back in the next business cycle, but they realized that it was due to this kind of still weird imbalance left from World War II, and they actually capped yields. They didn't allow interest rates to rise the next time around because they realized they'd screwed up the first time around. And it's the same thing here. I think we're fighting the wrong ghost, the ghost of Arthur Burns, and that everybody wants to be Volcker, and Jay Powell wants to have his book, and so he can look proud to his kids, when I think the reality is they're fighting the wrong thing. If we think about inflation now, well, we've got a bunch of really older people, which are the baby boomers, who are coming out of the workforce in record numbers. Labor force participation rate, i.e. the number of people in the workforce, is shrinking. And then we've got globalization plus technology in the middle of all of this. And that means that, generally speaking, I mean, we've seen this bloody chat GPT-3.
We're going to talk about AI.
So disruptive. This is what I keep talking about with this exponential technologies. They replace jobs. I mean, if you look at Amazon's workforce, there's 1.5 million people and 500,000 robots. Now, the robots work 24/7, 365, and they're probably more productive because they don't have sessions behind the water cooler and all of that stuff. And so they're cheaper. They're cheaper than people. So Amazon will just keep adding robots.
Similar to the 1970s and the post-World War II era, Raoul predicts a supply-demand imbalance on the horizon. He also highlights the difference between Chairman Powell and Chairman Volcker, and the contrast in monetary policy and how to tackle high inflation. Another issue that's affecting the global markets is the millions of people leaving the job force. With innovation and technology eliminating jobs, that leads to higher unemployment, which we'll start to see the negative effects of as early as the end of this year. What do you think about Raoul Powell's macroeconomic outlook for 2023, and how will continued rate hikes by the Fed impact prices this year? Let us know in the comments below. Thanks so much for watching. Don't forget to like and subscribe. This is Library of Wealth. We'll see you in the next video.